I want to introduce Boris. He is our speaker today. Boris, it comes from the tech entrepreneur background. He worked in Silicon Valley and Seattle. He's now in Sarasota. We're super excited to have him as one of our volunteers, as well as on our executive committee for SCORE Minnesota. He knows a lot about angel investing because he is an angel investor himself. So without further ado, I want to introduce Boris. Thank you, Boris, for joining us today and giving of your time to present this amazing info.
Sure, Paul. Thanks. Happy to help. So as Paula said, I do angel investing myself. I've been doing it for a few years after a long career in Silicon Valley, where I actually worked at these startups I'm investing in now. So if some of you saw my presentation a few weeks ago, I talked about how to get funding for your company, whether you're starting it or in business already. And we talked about all kinds of funding, whether it's bank loans or borrowing from friends or, your credit card, your home mortgage. But today I want to zero in a very specific topic that's relevant to only a very specific kind of company. And that's what we call a startup. Now, startup means many things to many people, but I want to define this context, what I'm talking about, because this is applicable specifically to these kind of companies. So what are these startups I'm talking about? They have high growth potential. Think of your Ubers and Airbnbs and Googles and Facebooks, right? So we're not dealing today with starting a local sandwich store or beauty salon down the road. Those are all great businesses, but it's not in the context what we're going to be talking about today. So these businesses have a high growth potential. They have innovation. So either an innovative product, innovative process, or innovative technology. They're capital intensive to get started. So, if it takes $5,000 for you to start a company, you can always just, borrow some money from your friends. But these companies, you can't do that. They require a lot of money. And they're usually not profitable for many years. You look at Amazon, probably hasn't made a profit for 20 years, right? So they constantly require, money to be infused in the business. So they're very different than your typical, kind of business you're probably used to. They cover a large geography, meaning the customer base isn't just, on your block or in Sarasota, right? They usually cover either the whole country or the whole world. Maybe not immediately, but in the future. The market size is very large. So, we'll talk later about this concept of a TAM, a target addressable market. But we're talking about, either millions of consumers or thousands of companies that can be your customer. And they have a moat, a barrier to entry, basically. So, this innovation is something hard to copy. So, you're not going to see hundreds of companies doing the same thing as you anytime soon, right? So that's going to start us with talking about. Paul, can you go next slide? So I'm going to talk about two ways of getting funding, and when one is crowdfunding, and then I'll talk about angel investing later. So first of all, crowdfunding. Well, what is crowdfunding? So it's taking advantage of all the innovation in the last 20 years, right? People are online, they're excited to do things together. So this taps into the large pool of individuals who are online using social media, they're marketing to target them, and each one doesn't chip in much money, but together it adds up, right? So you're taking advantage of a large group of people, right? You're not targeting one investor at a time. So that's crowdfunding in general. So there are two types of crowdfunding I want to talk about. The most common one is reward-based. So you're offering people a reward in exchange for their money. So they're not going to get a part of your company, but usually this works with products that are very consumer-based. A lot of it very creative. So you're coming up with a new kind of hairbrush or a new kind of piece of clothing or something, and everybody wants you to be successful because they want to see this kind of product out there. And so they'll chip in some money and help you get started. In exchange, they'll get the first version. Once you build the product, you'll ship them a copy, right? So that's a typical structure. There can be other rewards. It doesn't have to be an expensive product. It can be other gifts they get. But basically, they get excited, and you give them some reward. And it's great, like I said, for for creative product, things that get people excited. Some examples, I put some links here. You've probably heard of GoFundMe for other purposes, but it's also for this. One of the larger ones that I usually see is Kickstarter. A lot of cool new products have gotten their start in Kickstarter. So we'll talk about that later. Another kind is equity. This is more traditional, right? Where people are actually investing in your company and not just wanting the product, right? So they want to see a company they can make money on. So they want to participate in your growth, right? And this is regulated by the SEC. So there are forms you have to fill out now and other things you have to do because you're taking on investors. And later on, we'll talk about Angelus, which is the most common one in Silicon Valley. There's also WeFunder and others out there you can look at. So let's look at Kickstarter. That's a common one you probably heard of, right? So how does it work in Kickstarter? Well, basically you just bring together a lot of people on the platform, and Kickstarter is just one platform. You pay a fee and you set up your campaign, and you have a deadline. So you say, I want to raise $10,000 in a week or a month. And then you market the heck out of it, and it's an all or nothing kind of game. So basically people come in and they say, I want to chip in $100, and basically at the end of the month or the week, if you've reached your target, like $10,000, they'll collect all this money and give it to you. If you only reach $9,000, you don't get anything. So you have to be very careful on what your targets are. And so usually the amounts are lower, and you can do this in multiple rounds, but that's how it works. So you run a campaign and you raise money for your startup. So how do you make it successful? On platforms like Kickstarter, there are 10 steps we'll talk about. So you want to select the model, right? I talked about rewards. There's equity. There's actually others where it's more of a debt structure. There's stuff for nonprofits. So you want to see what's appropriate for you. Then within that model, you want to pick a platform. So you research, things like Kickstarter or Angelus, etc., and see what you feel is the best one for you. You pick a target amount. As I said, this is very important, right? Because some of these things it's all or nothing, right? So you want to pick an achievable amount, right? You want to figure out the right compensation, like a reward. So in equity, it's just what percent of the company they're going to get, and these other things like Kickstarter is what they get. Do they get the first product or some other kind of gifts? You need to have enough there to make it worthwhile for them, but not too much, so it's not too costly for you, right? You want to tell a story. You want to tell a great story to get people excited. How you got started, why why this inspirational idea, why this product should be out there, etc., right? And learn from others. So you want to research how other successful Kickstarter programs or whatever platform you're using, how others did it successfully, right? And see what they did, and use the best practices from them, right? Make sure you have the right mindset. It's really it can be hard and challenging, and there's there are thousands of campaigns at once on Kickstarter, and that's just one platform, right? So you're competing against a lot of other campaigns, and have reasonable expectations, right? You want to leverage the crowd. So make sure people who are already in and who are already given money and who are excited, make sure they share it with their friends, they retweet it, they repost it on Facebook, LinkedIn, whatever. Use the crowds, right? And make sure you establish contact with these people. There's a lot of people that may be excited, but they may ask questions and have comments and feedback. So the more responsive you are, the more excited the crowds will be, right? Just like any other business. So one of the things we talked about is you need to market this, right? This is so if any of you have seen this, other SCORE workshops and webinars about digital marketing, this is pretty much the same. So just like you would digitally market your product to consumers, your business, here you have to market the campaign. So you have a campaign on a platform like Kickstarter, but like I said, there are thousands of campaigns going at once, and just on one platform, right? So it's probably tens or hundreds of thousands going on across the world. How do you get everyone's attention? Well, it's the usual practice from digital marketing. So I won't go into all the details, but you need to have a website and a landing page. You need to basically build up your network on social media and make sure people are following you, and where you can announce things. As soon as you launch, you want to issue a press release to make it sound like a really big thing. Here's some links where it's very inexpensive to do this. You can do it by yourself. You don't need a marketing department. Email marketing. Have lists you can email or know what market you're targeting, or if you already know people in your market, make sure you email everyone. And use the platform tools. All these platforms, I mean, one of the reasons you're paying them is because they have the tooling in place, right? So make sure you learn how the platform works and all the tooling they have to help you. Angelus is kind of segmenting into, what I'm going to talk about angel investing, but Angelus is also a platform and it's based on equity. So here there's investors, they want to stake in your company, but maybe they don't know themselves, how to invest. They're not, they're not active angels, but they can go on Angelus and find great investment opportunities, and they can follow others. There are people who do this more professionally, and so they're kind of the lead investors, and they can subscribe to those people, and they'll see where these people are investing, and they can chip in themselves. The nice thing in Angelus, the minimum I think is like $1,000, so you don't have to have a lot of money to do this kind of thing, unlike actual angel investing, right? So how do you run an Angelus campaign, right? Well, it's kind of similar to Kickstarter, except some differences in terms of equity. So you create a profile on Angelus, you explain, how much you're trying to raise, and then the story behind your business, etc., right? And you want to profile yourself on there, right? It's kind of like LinkedIn, everyone has a profile, people do recruiting on there, and then people also fundraise, right? So you can have a refer on there, since obviously, there may be thousands of people interested. You can't have everyone like doing reference checks. So you can pick a person, who everyone can contact, right? Again, you want to, you want to really leverage your network. So hopefully you're connected to other people on AngelList or on LinkedIn, right? And you want to point them to this AngelList campaign you're doing, right? You can use your profile on AngelList as kind of your executive summary, right? So point people, to AngelList, and all the information should be there, right? And you can capture them there, and right there they can invest, right? Just like in everything else, be responsive. If you reply within hours instead of days, you're really impressed the audience that you're a founder that's on the ball, right? Even if it's dumb questions, you never know who will invest, right? You want to find the lead investor. So these are called usually, syndicators. So people will create a syndicate, meaning, someone has a good reputation on there, and they constantly invest. And then, people who don't know what they're doing can just, can follow these lead investors. So like the groupies, right? So if you find a good lead investor, and they announce that they're investing in your startup, a lot of people who subscribe, to their announcements will go on there and take a look, and that, and they may invest too, right? So you immediately have an audience, right? And then you just fill in around again. You contact everyone and you reach out to people, and you raise as much as you can on there, right? And make sure you keep your profile active. You may raise money again and again, so it's not a one-time thing. So make sure information on Angelus is constantly being updated, and you're in touch with people on there. Okay, so let's turn now to angel investing, and this is a little different, right? So now you're no longer reaching a large crowd. You're going to individuals or groups. So a lot of people ask, what is an angel investor? So they're not like, they don't wear special uniforms or have special jobs, right? These are just ordinary people. But the real definition is they're an accredited investor who provides financial backing for startup in exchange for for a piece of the company, for equity in the company. And this is important, that accredited investor, this is an SEC definition. And so once you go and raise money on the platform, they handle a lot of the work for you. But now if you raise money on your own and you pitch to angels, you're now regulated by the SEC. You're like in the stock market. So we'll talk later about having a lawyer and everything like that. But you're only allowed to raise money from an accredited investor. An accredited investor is defined by the SEC as someone who has a net worth of $1 million excluding their primary home, or income. I think it's $250,000 for a couple for 2 years. So basically, SEC is trying to make sure you're raising money from people who can afford to lose their money. So it is a requirement. You have to at least ask them if they're an accredited investor, and there's a paper they sign. So basically, these are high net worth individuals, but they can have jobs. Usually they're either corporate executives who have an understanding of a certain space they want to invest in, or these people are retired and come from a certain industry they want to invest in, or they were once a founder with a successful business, and now they want to invest in other entrepreneurs. So they come from all walks of life. the biggest question I get actually is where to find them. And it's not as hard as you think, right? So you probably know some angel investors out there. Use your network. Whether you have a lawyer or a doctor or a financial advisor or someone you work with, all they have to be is an accredited investor, and they may be interested. And especially now, you hear in the news of all these IPOs and unicorns and SPACs and all this kind of stuff. Everyone's interested in investing. So you probably know angels, that they're not these magical entities, right? So reach out to your network first. Look on LinkedIn, see who you know, and reach out to them, right? There are also angel groups, right? So some angel investors like to work on their own. Others, want to share in the work. So angel groups are usually either geographically based. There's one in Sarasota. It's called Bridge. There's some in other cities. Whether it's Chicago, St. Louis. There's a few in Seattle. There's a lot in Silicon Valley, etc. And other angel groups are based on other boundaries. So they're not based on geography. People from all over the place, but they're based on certain demographics. There are some women founders who want to invest in other women founders. Some who want to invest in military veterans, minorities, etc. So, if you're looking for angel investors, it's good to look at the groups and see which ones, would be interested in you, right? And you don't have to stick to your geography. If you're in Sarasota, you can still pitch the group in Chicago. And there are some famous groups out there, like I think it's East or West Texas, that's kind of, famous in the angel circle. So, you can look across the country, across the world, and you can go to their website and submit your pitch deck, and they'll decide if they want to talk to you, right? So some resources here you can get, again, Bridge is the local organization, and there are some resources out there where you can look up all kinds of groups. There's some government agencies that can help you, connect you, etc. And then there's incubators and accelerators. So there's gonna be a talk, I think, next week about this. So I won't go too far into it, but they're a great resource. Once you're in one of these, they usually have people on staff that can introduce you to angel investors. They have their own network or their own, list of angels they work with. For example, I work with some incubators up in Tampa and some in Silicon Valley, right? So that's a great, reason to be part of an incubator or accelerator. So how does this process work? How do you get money from angels? So first we talked about you need to find them. Once you found them and they seem interested, you schedule an initial meeting, whether it's a group of angels or just an individual angel, whether it's over coffee or over Zoom, or you fly out for a presentation. Right? Usually they're 20, 30 minutes. You keep it short. I get pitches every day, and I take meetings at least once a week. So you don't want to do a long one, right? It's just initial meeting. It's like a resume to get in the door, right? If people are interested after that, you schedule a follow-up meeting, and there you go off script, and basically people will ask Q&A, and you have to be ready to answer the hard questions. They may ask you to bring some documents, etc. Right? And that's usually, hour or two meeting, right? Where you go into the nitty-gritty and people really decide whether this makes sense for them to invest in, and they see how well you know your business and how well you're executing. If there are large investors, you can negotiate the terms. We're going to talk about kind of the structure of the deal a little bit later, but large investors, you negotiate terms. Others, you just have your terms and they take it or leave it, right? You don't want to negotiate with 100 people, right? Then if everything's all set, the last step is due diligence, and usually that just involves giving access to your data room. A data room is usually just a folder in a Google Drive, and you share it with them. And in there, all your QuickBook reports on how the business, is performing. So basically, all they're checking is if everything you told them is true, right? If you sign big contracts with customers, that they want to see them. If you have partnerships agreements, they want to see them. So this is usually proprietary stuff. So you don't want to give anyone access, until they're serious and this is really the last step before investing. And then you send over the investment documents, and again, we'll talk a little about the structure of them, but basically whatever structure you take, you send over these documents. And nowadays it's mostly on DocuSign. They sign the documents, and then you give them wiring instructions. So hopefully you have a bank that can provide you with wiring instructions into your business checking account. You don't want to do old school ways like sending in a check, because checks can get lost and then people can change their minds. And you want to get the money as soon as possible after the person says they want to invest, right? And usually these are larger amounts of money too. And you want to keep in touch. So just because they gave you money doesn't mean you never need them again, right? They may have valuable advice to give you. They may be able to help you, or they may want to invest even more later. So you want to keep in touch. Most of my founders either email once a month or once a quarter with investment updates. So they tell you, just like on Wall Street, how's your investment doing? So the company has more customers, or you just won a big deal, or you came up with the next version of your product, or you just hired some great person. So keep your investors excited, involved, and usually in those emails you can ask them for things. You can say, we're looking for this kind of person. If anyone knows a great engineer in this thing, please let us know. Or if anyone knows this kind of customer, please introduce us, etc. So utilize those investors for more than just money. It takes usually a few months. This is very variable. Some people spend years on this, but after a few months, I definitely recommend take a break and then do another round, right? It's like looking for a job. So you want to leave time to run the company, actually, right? This can be very time consuming. Usually people spend a few months, they raise a few $100,000, and if they need more, they just rinse and repeat a few months later. So you can keep going. We just call them rounds, and usually if business is doing well, you can raise your terms, right? So that's how generally it works. So before you get started, it's really important to prepare. Like I said, active angels get a lot of pitches. So I get usually more than one a day, and most of them, just you just don't have time to deal with. And if you do deal with them, you want to make sure the founder is prepared, right? There's nothing worse than coming to a meeting with angels and and not having all your ducks in a row. It doesn't look professional. Investors want to want to invest in the best founders possible, right? So how do you prepare? The most important thing is the pitch deck. Pitch deck is usually a PowerPoint slide, a PowerPoint presentation. It's about 12 to 13 slides. Usually when I get a pitch deck of 50 slides, I just delete the email. It's too long to read. I'll talk a little later about what goes in the pitch deck. The pitch deck is something you either email to folks, like a resume to get in the door, or it's what you present at the meeting, at their first meeting, right? And you talk to it. You want to be legally ready. You definitely have to have a lawyer. This is not your local little business where you can kind of do it yourself on that website. Like I said, you are now SEC regulated, and you want to make sure you're compliant. You usually need to be a Delaware C Corp. That's what investors want, and I won't go into all the reasons for that. And you have to have your investment documents ready so that people are ready to invest. You got to present a document that they're going to read over and approve, right? So it's either going to be a safe or a convertible note, and I'll talk about those things later. You want to make sure your financials are in order. This is very important. I've seen great startups and founders who are pitching, and one person in the room is a finance person, and they go into the stuff and they shake their head. All right, so you need to at least have a bookkeeper and be using QuickBooks or something like it. It's not something you just want to have receipts in the drawer. I mean, you're trying to to one day build a large company, so you got to show people that you're serious. All right, so you have to have your data on the past, if you've sold anything or if you've spent any money, which you probably have, and your future projections, etc. Right, so your books have to be in order. Ideally, you have a CPA, part-time who's helping you with all that. I mentioned the data room, so you don't need that very start, but as soon as people are ready to invest, you should have a data room ready with all your financial reports, etc. I've seen founders that have done a great job and had all these excited investors, and then they were too busy to present a data room, and investors waited months and months until they lost interest, right? So I would have that ready up front. And then if you have any kind of innovation that's patentable, investors like to see assets, and really the only assets you're going to have early on is intellectual property. So a lot of founders think it's very expensive, but provisional patents with the right lawyers who are looking for a follow-on business can be very cheap, maybe $1,500. One or two of these can actually show a company has real assets. So that's a very useful thing. So let's talk about pitch deck. This is really important because usually most founders, I find, have very poor pitch decks because this is not their area of expertise, PowerPoint and just present. They have a great story and they've dreamed of this for years and they want to tell you about it. But if you make 100 slides that reads like War and Peace, people just are busy. They're not going to look at it. And this is like a resume, really. There's no value here in innovation. People are just going to skim it, get the key points, and decide whether they really want to talk to you or not, right? So you just want to present them all information you're looking for. And this can vary obviously with the type of product and the business you're in, but this is in general what what I look for. And you can go and Google presentations from Airbnb, Uber, etc. when they were in the early days. You can see examples of really good pitch decks, or at least pitch decks that were successful, right? But the general flow of it is you state the problem, right? Why are you in business? What problem are you trying to solve in the world? You state the solution. This is the overall solution, not your product, but and then you drill into your product. Maybe you have a screenshot of your app or your website or whatever. And then the question we ask is, are there other products like this? So you explain the competition, the major competitors, and how their features compare to yours. Then you go into the market. How big is this market? Is this something you can really grow into? What's the TAM? The TAM stands for Target Addressable Market. And this is just in this math, right? So if there are maybe 10 million potential customers and each one in your product costs $100, well, you just do the math, right? 10 million times 100, right, is $1 billion, something like that, right? That's the most money you can possibly get. I'll just tell you that VCs, the big VCs, famous like Benchmark, Sequoia, Kleiner Perkins, at this point, they're building unicorns. They're looking for a TAM of at least $10 billion. Right? That doesn't mean they expect you to get all of it because you're gonna have competition, but they want a really big market. But obviously, angels, you can be smaller, right? You want to have a go-to-market strategy, right? So how are you gonna get started? So once you're big, it's easy. You have a VP of marketing, VP of sales, all those departments. But right now it's small. It's probably just you or you and a few people, right? So how are you going to launch this product or get the product out there and grow your company initially? How are you going to bootstrap? And they want to see a strategy that they feel you can execute on. Then the team. This slide can go earlier or later, depends on how famous the team is. But you want to show who's running the business, right? So who's the founder? Who are your key advisors or your key employees, executives, etc. You want to show what school they went to, what big company they worked at, etc. Any way to get the concept of pedigree, traction. So investors want to see, like, is anyone going to buy this product, or are you capable of selling this product, right? Marketing and selling the product. So if you've had any success, you want to really highlight it here. So how many customers do you have? How much revenue have you collected, etc. Right? You want to show financial projections. Now, I personally never look at this, but many investors feel comfortable with a three-year projection. So after you've shown what you've accomplished in traction, you want to show what you plan to accomplish. So over the next 3 years, how much revenue you're going to get, or how many customers, etc. Usually founders have no idea what's 3 years in the future, but you need to come up with something and justify it. Anything is okay as long as you can justify how you're going to get there. And then you want to explain this fundraising around, like, why are you pitching? How much money are you trying to raise? How long do you think the money will last until you need another round? How are you going to spend the money? What are you going to accomplish by the end of it, etc. And then the last slide is always the vision slide. So, today you may have a small product, right? But eventually you plan to conquer the world, right? So you want to show how big you think, right? Not just the current thing at hand. Just keep in mind in the pitch deck and everything you do in terms of presenting to investors, and this will apply, later on when you're going to bigger rounds, is that investors look for 3 things, and it's called the 3 T's, right? And that's team, traction, and technology. And make sure you cover that in your pitch deck. So who's building this company, the people involved, what technology, what innovation is there, and what traction do you have? What have you accomplished so far? So now, how does this actually look like, legally, and how do you actually create an investment document that people will sign, right? So obviously you work with your lawyer very carefully, and I'm not a lawyer, but I'll give you the general outline. These days there are 2 structures that are out there. There's the old one, which has been there forever, which is a convertible note, and this is used for other kinds of investment too. But convertible note is simply, I'm going to invest, $100,000 in your company, and I'm going to get 6% interest every year. And at some point on the trigger event, that loan will convert into equity at the set terms, and we'll talk about terms later. And then recently there's been innovation just to cut down the paperwork and the legalese. It's called a SAFE agreement. It's really the same thing without all the loan and the interest and everything, because really people aren't investing for that interest rate. And the SAFE, it stands for Simple Agreement for Equity. And it's basically a very short document. So convertible note is like 15 pages, the SAFE is 3 pages. And it just says kind of the same thing, is that we're taking your money, and at some future point on a trigger event, that this agreement will convert into a specified amount of equity, based on the terms below. And that's it, right? So basically you're signing it. I mean, you have a document and people sign and they give you money, right? It avoids all the stock market stuff of issuing actual certificates of stock, etc. And it's all based on a trigger event, and the trigger event is what's called a priced round. And it's very simple. Basically, in the future, it assumes if you're successful, you're going to raise money from actual VCs, and we'll talk about venture capital, but professional organizations, and they're not going to do these kind of safe agreements. They actually want a priced round, meaning they actually want the stock in hand. They want to know exactly how much stock they're getting, so they're going to negotiate with you, saying, okay, we're going to give you $5 million in exchange. We get 20% of the company. So that's going to give you a valuation, right? Meaning they're going to pay per share. So now your shares have $1 value. It's called a price round because now your shares have a fixed price. And at that point, these safes or convertible notes will trigger, and they will convert, and it's based on that price, right? But since you invested early and took a bigger risk, you should get a discount, right? You should get a better deal than the VC, right? So to do that, there are 2 terms that you negotiate. One is called the valuation cap, and the other one is called the discount. And in some cases you only have one, some cases you have both, but you have to have at least one. So the valuation cap is the maximum value the company can have for your terms. So basically, in case in the future your company does really well and you get a price round which is much higher than this cap, you still get the cap, so you get much better terms. So if you invest at a cap of $5 million, and then the next round's at $20 million, right? You're going to still get equity as if the valuation was at $5 million. So you can get 4 times better terms than the VC because you came in early. And the discount is applicable if the round is worse than you had. So if you invested at a $5 million cap, but the next round is at $4 million, right? You still want to get better terms than that guy because you invested earlier. So you get a discount to what they got, and that can range from 0 to 25%. And the valuation cap, really ranges, especially these days with the bubble. But in Silicon Valley, generally it's between 6 and 12 million. Around the country, it can be as low as 1 million. And sky's the limit. I've seen 25 million for famous founders, etc. So that's kind of how it works. And usually, the check size from angels is in Silicon Valley, it's between 25,000 and 100,000. In places like Florida, founders will accept checks of 5,000 maybe. Remember, any smaller than that, it's just not worth for the founders, to deal with all the paperwork. Anything bigger than 100,000, usually institutional money. It's not an individual who's doing it. So that's how the legal process works. So now I just wanted to go a little bit into the venture capital world. So, most of you probably aren't at that stage yet, and it's very rare these days that the founders go straight to venture capitalists and skip the angel round, although it is possible if you have a big executive from a successful software company or a founder has done before, they have enough reputation, they can skip angels and go right to the VCs. But generally this happens the next round after angels, once you've accomplished more and have more traction. So the difference between angels ventures, the venture capital, think of angels like hobbyists, who are doing this on the side, and venture capital are professionals, right? So this is their full-time job. And venture capital is it's if you're in the investing world, there are different kinds of investments. There's fixed income like bonds. There's the stock market, right? Equities, and this is the private equity market. So investing in companies that aren't public yet. And within that, there's a lot of companies doing turnarounds and like that. The subsector of that is venture capital. And this usually involves investors, they're called limited partners. It can be a pension fund or high net worth individuals who want to invest in this fund and make a lot of money, but they don't want to be involved. And then there's the general partners. Usually a VC fund has 5 or 7 or 9 general partners. It's their job to invest, and they get a salary. They work for the company. It's a full-time job. They're professionals. And there are famous venture capital companies like Sequoia, Benchmark, Kleiner Perkins, Lightspeed, Greylock. But there's actually a lot of small funds you probably have never heard of. There are thousands just in the United States, probably a lot more than that around the world, right? And with the bubble that's going on, more and more are formed every year, right? All they have to do is raise some money. Some of them are really small. So, I've seen some as low as $5 million where the fund only has $5 million to invest. On their hand, the big guys usually each fund is $1 billion, right? And the fund is just one investment vehicle where they have a few years to invest the money. So they usually invest in, each founder makes 6 or 8 investments. He sits on the board, so these terminologies, they shift around, but basically there's something we refer to nowadays as micro seeds. So these are really small guys. They write a check of $100,000. Sometimes they participate in the angel round itself. Sometimes you raise money from angels and the micro seed funds. Sometimes they participate along with the seeds, but they're not big investors, but it's the entry level kind of. Then traditionally there are the seed funds, and seed funds are usually nowadays the first professional investment you get. And Silicon Valley, this usually involves a few $1 million, maybe $3 million investment. And the seed funds, usually a fund, they play in one of these spaces. So if a fund does a seed, they're not going to do a Series B. They're not going to do micro seed, right? They're a seed fund, and it's based on how big they are. Seed funds usually has at least $20 million to 50, 70, $100 million, and each investment they make is $500,000 to a few $1 million. So when you're raising a seed fund, you may raise a few $1 million from one fund, or one fund may lead the round, sets of terms, and then others will follow. And then you get traditional Series A, B, C, D, E. Usually these famous companies from this earlier, they're usually only in Series A and B, maybe in C. Once you get into the D round, you're dealing with usually kind of late stage investors, even mutual funds like Vanguard. But that's kind of how it works. And some of the differences and similarities between angels and venture capital is, they definitely do a price rounds very rarely, maybe in micro seed, but most likely venture capital want the price round. They want the dollars per share. They want the stock, etc. They get preferred shares. Angel investors also get preferred shares, which means they have preference over the shares that employee and the founder have. So in case the company is liquidated, they get out first. In case there's acquisition, they get better terms, etc. And they get rights usually to undilute the next investment, right? They get a board seat starting usually at Series A. Usually it's seed or micro seed, don't get a board seat. But once you get Series A, they get a board seat. So they start having control over the company. And this is why they're not called angels, because angels really are there to help you, and they don't run the company, or they don't have control over the company. But professional venture capitalists, they want some control. And by Series A, usually they have the right to fire the founder. Obviously, it's the nuclear option, but it does happen often. Companies, many start successful without their founder. So, one of the big changes is that, once you start giving them board seats, etc., the founder now has a boss. So the founder is like the kid, and the VC is the parent. So it's a different kind of relationship than in the angel investment world, where the angels really are angels, and they're there to help you and guide you and whatever help you need. But they take a back seat to the decision making. Right? So that's kind of what you can look forward to after angel investing as you get into the venture capital world. So now kind of, just to bring it all together, we've talked about crowdfunding, raising money there, raising money through angels. You're probably wondering, which one should I do, or both, right? So you can do both. Usually people choose one because it's just more appropriate, and it's really based on you, the founder, and your skills and the type of product, type of company you have. So the factors to think about when deciding which way to go, one of them is, how do you want to find your investors, right? Do you just want to blast it out there to millions of people and see who bites? Are you really good at digital marketing and social media? If you are, then crowdfunding is best. If you're very good at networking and sales, right, you probably want to do one-on-one with angel investing. The type of investors you want to deal with. So obviously in crowdfunding, it's just everyone out there. It's the masses, right? With angel investing, you're dealing with high net worth individuals who probably have some expertise, etc. So who do you want as your investors, right? Due diligence, obviously on crowdfunding platforms, against the masses, they're not going to be able to do much due diligence. Whereas angels, they're going to dig into your company, they're going to ask you for a data room, etc. So are you ready for, for a deep round of due diligence? Will you pass it, right? The product, is your product inspirational to large masses, or does it require a lot of expertise? Do you have a special widget that's only do you have a new kind of heart pump that only cardiologists will understand, right? In that case, you want cardiologists or doctors or angels, right? It's not going to appeal to the crowd, right? Or are you making a new kind of T-shirt, right, where everyone will understand it? Do you want assistance? With crowdfunding, you just get 10,000 people to chip in a few bucks. They're not going to help you very much. You're not going to know who they are. Whereas angel investing, you're getting people a lot of times who are executives in a certain industry or retired, et cetera, and they have a lot of expertise and they can help you, with whatever you need, whether it's finding customers or understanding the industry or recruiting, et cetera. The time you want to spend, crowdfunding, you can do a campaign over 1 week and just market the heck out of it and you're done. You may raise less money, but it's over, right? You can focus on your business. Angel investing is not fast, right? Because you got to contact people one-on-one. So it may take a few months, may take longer, right? So how much time do you have? And the cost, there's no cost to doing angel investing. Maybe the cost of driving to a meeting or buying someone some coffee, right? Whereas these crowdfunding platforms, they charge a fee, a percentage of the money you raise, 5 or 10%, right? And then equity, do you want to give up for your company? If you don't, you can go crowdfunding and give them some reward and you're done. Whereas, angel investing will always want, a part of your company. That's why they're there. So those are the things to think about, as you decide which way to go. So that's angel investing and crowdfunding for you.
Well, thanks, Boris. That's really amazing, great information for people. Honestly, just giving them such an awesome layout of step-by-step what they need to do. Thank you so much. And I know we had put together a little list here of must-reads for startups. So if you're new to this process, obviously, you want to gather as many resources as you possibly can. And reading some of these books will really help you in setting the right course. If you're looking at raising capital or, even just structuring out how to do a startup. And I don't see any questions in the Q&A at this point, but I wanted to ask you one question, Boris, because in my experience in working with angel investors specifically, and venture capitalists as well, but can you talk a little bit about the NDA and the utilization of an NDA in a startup, and the receptivity of investors to the NDA?
Yeah, that's a good question, actually. I get this. And so I'll tell you, it kind of depends on expertise. So in Silicon Valley, I've never heard anyone ask me to sign NDA in terms of for investment. NDAs are very useful for customers or partnerships or employees, but in terms of investment, if you go to Silicon Valley and you talk to a big VC firm, they will never sign NDA. I mean, never, right? Because what they're investing in is the execution, the people, right? They're not investing in an idea. Everyone's got ideas. When I was in college, there were homeless people that had great ideas, but it doesn't help. So an NDA really isn't very relevant. But places like here in Florida where there's not as much expertise, I do get people who ask me to sign NDA, and I personally I sign it just to humor them. But it's really not something investors want to do because again, they want to be able to talk about this with their other angels, and share ideas and decide about the investment. And when you sign NDA, you really can't talk about it, and it's not a very collaborative process. And honestly, I always tell people, once you send your pitch deck to anyone, it's out there, right? So it can't be proprietary. Your pitch deck, can't be the secret sauce that makes your business. Otherwise, you don't have very much, right? So again, I don't recommend NDAs in terms of on the investment side and the investment process, right? It's not
absolutely. Yeah, that's why I asked that specific question, because I mean, typically it's a mixed bag, but we've got a couple of questions that have come in here. This gentleman said, I have an idea, want to get a provisional patent. Where can I find the right attorney and how do I vet them?
It's a good question. So the problem, So there's two things you'll look for. I mean, one is expertise, the other one is cost, right? It's very expensive. And this is why like big companies like, Qualcomm, they crank these out every day because they can afford it, and it scares away other people from, from trying to, to copy their stuff, right? But as a startup, you can't just crank them out because, they can cost you $20,000 or something, right? A lot of work. So what you want to do is first of all, have a provisional patent. They're much cheaper. I've seen people do it for as little as $1,500. They start the process, and then when you have more money, you can finish it. And the lawyer usually will lower his price on the provisional, knowing that, you'll come back to him with the, the final process if you do well and pay him a lot more money, right? So you want to find a lawyer who's familiar with startups and is priced accordingly to make it affordable. And you just want someone with expertise, right, in your business. So if you're doing patents on medical products, you want to see how many of those he's done. So experience with the size of your company, like startups, like, he's not a patent lawyer just for big companies, but also one that understands your area of expertise, right? And, it's another area you can look at incubators and accelerators, and they usually have lists of who they work with. They're kind of like, there's probably only a few in Tampa that really specialize in this, right? So you can, just reach out to folks. Other angels can point in the right direction who they work with. But basically, you want expertise and pricing.
Great. And then this is a really good question. Do angel investors work with nonprofits as well?
This is tricky. So almost all the incubators I see in Tampa, Embark and Wave, etc., they're all nonprofits, which is very different in Silicon Valley, where they're all in the business of making money. So some of the processes is kind of a nonprofit. But generally, angels, are there. I mean, they're there to help startups and to encourage founders, but they're also there to make money, right? And so I don't know of any angels per se that invest in the structure for nonprofits. Now, many angels are high net worth individuals, and they give to charities. So in a different context, they work with nonprofits and they help nonprofits, but not in this kind of structure.
Okay. And then a specific question for minority startups. Are you aware of any angels that are more friendly to minority startups?
Oh gosh, this day and age, I read articles about every day about some VC fund that started to only fund African Americans or Hispanic or women, etc. So there's a lot. There's so many that I don't even remember the names of this. But if you Google and you search out there, or you contact me, you can easily find a lot of news on this. It is a trending thing right now. Yeah.
And I'm going to try to interpret this question, but is there a specific industry that won't work for angel investing for startups, like real estate and construction, for example? Or are there any industries that are kind of off limits here?
Good question. Illegal ones, pornography. I mean, you may laugh, but actually in Silicon Valley, there are a lot of highly profitable adult video companies, and they make huge profits, but they can never go public, and they can never really take on these kind of investors, because there is no kind of, formal exit process. So anything illegal or in the dark area, I guess. Otherwise, real estate and stuff like that is open game, as long as, again, it's not so much about the space, but about what you have. You have to have innovation. So real estate, it's not just, if you're just, flipping homes one by one, it's not very interesting. But if you have a new technology that real estate agents can use or property managers can use, it actually, in Florida, it trends very well. There's a lot of, property tech, we call it. So, if you manage a bunch of apartments, the door locks can be automated, the lights automated, the air conditioning automated, etc. The billing automated. There's a lot of startups there. So industries are pretty much anything where you have innovation you can work with.
And then this is a follow-on question to the question that I asked about the NDA, specifically for physical products, if you would think an NDA would be useful for that.
Well, again, depending on who, when you say useful, depending on useful for who. For, the founder, I mean, obviously they would prefer an NDA in anything, right? They don't want their secret spread. They don't want people talking even about their pitch deck. For investors, they want to talk about things that, they want to cross-pollinate and use ideas elsewhere and etc. Right? So NDA is never useful for an investor. right? It's always useful for a founder. So it depends on, your leverage. Like I said, in Silicon Valley, like no one will sign it. You can ask, but no one will sign it, right? If you can find investors who will sign it, then it's great. So you can always ask, but I mean, usually the answer is no.
Okay, great. Well, thank you so much, Boris. Really great presentation today. Just super useful for folks. Again, want to thank people for coming on to the workshop today. Don't forget to visit our website and sign up to get a mentor if you need a mentor and asking specific questions. And also we'll be sending you an email with the presentation as well as the live recording of the video and our event surveys, which always helps us to ensure that we're providing you with great content and useful content. And getting a lot of very thankful comments from folks, Boris. So thank you again. And thank you all for joining us today. Appreciate your time, and join us next week, same time, same place. We're going to be talking about incubators and accelerators. Thanks, Boris.
Thanks, you guys.